Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. 010103 Compliant Tax Planning for an Ontario Corporation with $200,000 of profit. This video presents a direct informational narration of the source document. The source document establishes a professional tax planning framework for an Ontario-based website business. The primary objectives are to outline compliant methods for extracting $200,000 of corporate profit, to provide standardized modeling for salary and dividend allocations, and to delineate factual boundaries from items requiring certified professional accountant confirmation. The known facts define the entity as a Canadian-controlled private corporation operating in Toronto.
A critical requirement of the planning framework is the verification of factual boundaries. Mandatory and recommended confirmations include precisely defining the CAD $200,000 figure, specifically whether it represents gross revenue or net retained cash, and verifying the continuous Canadian-controlled private corporation status. The document establishes strict information classification boundaries, explicitly separating established known facts from variables that require formal confirmation by a certified professional accountant prior to execution.
The framework relies on authoritative sources, specifically current federal and Ontario tax legislation, to establish source priority rules. Specific tax parameters mandate independent validation to maintain accuracy. This process establishes a standardized baseline for scenario modeling. By adhering to this baseline, all comparative analyses between salary and dividend distributions utilize the exact same profit definition, ensuring that mathematical models remain consistent and free from distortion.
The source outlines 9 mandatory execution steps for compliant tax planning. The sequence begins with confirming corporate qualifications, followed by isolating and addressing non-salary expenses and reimbursements. Subsequent steps involve modeling the specific salary versus dividend allocations, reviewing indirect tax obligations such as GST and HST, and formally documenting the structural decisions. The final phases require creating a standardized execution calendar and compiling a comprehensive review package for the designated certified professional accountant.
The document specifies a mandatory output structure for the planning memorandum, accompanied by stringent quality, acceptance, and failure conditions. It details explicit prohibitions, firmly stating that personal consumption cannot be lawfully disguised as a corporate expense. Adherence to these strict parameters is a mandatory condition for the memorandum's validity, ensuring all execution plans remain fully compliant with established regulatory standards. Part 2 of the detailed planning memorandum opens with a standard disclaimer regarding professional execution. The quick table of contents structures the subsequent analysis, leading to a core execution conclusion. This conclusion outlines the lawful priority of cash arrangements and presents 3 distinct strategic pathways: maximizing immediate personal cash extraction, maximizing retained corporate capital, or establishing a balanced approach for long-term wealth accumulation.
The planning assumptions restate the known facts, specifically identifying the entity as an Ontario business with no alternative personal income streams. Critical assumptions include continuous Canadian-controlled private corporation status and an applied combined small business tax rate of 11.7%. The document emphasizes crucial informational gaps, such as precise fiscal year ends and existing shareholder loan balances that must be formally confirmed by a CPA to prevent material alterations to the modeled outcomes.
The structural modeling relies on key 2026 tax parameters. The analysis details the federal and Ontario small business tax rates, noting a critical mid-year drop in the Ontario rate from 3.2% to 2.2%. The parameters also define the limits for 2026 Canada Pension Plan contributions, registered retirement savings plan maximums, tax-free savings account limits, and the fundamental goods and services tax registration thresholds.
Execution must follow 6 levels of lawful tax planning priorities in strict chronological order. The sequence dictates first paying all bona fide corporate business expenses, followed by reimbursing the shareholder for approved out-of-pocket costs and repaying any outstanding shareholder loans. Only after these primary obligations are met does the process move to retaining operational funds, determining the optimal salary and dividend mix, and finally structuring compliant employee benefits.
A structured decision guide facilitates the choice between prioritizing salary or dividends. The framework evaluates the immediate need for current personal cash versus the long-term necessity of generating RRSP contribution room and securing Canada Pension Plan entitlements. It also assesses target levels for passive corporate investments, utilizing these factual inputs to channel the narrative into the appropriate baseline strategy for the specific corporate profile.
The scenario modeling evaluates the CAD $200,000 profit across 6 distinct structural options. At one end of the spectrum, an all-dividends distribution approach yields the highest immediate personal cash, calculating to approximately $134,641. Conversely, the maximum salary scenario provides the lowest immediate net cash retention, yielding approximately $129,752. The standardized table quantifies the exact financial differences across all intermediate allocations.
The standardized table outcomes are derived from precise formula logic, incorporating mandatory Canada Pension Plan contributions and corporate dividend capacity calculations. The mathematical conclusion confirms that an all-dividends approach generates the maximum immediate personal cash. However, the analysis explicitly outlines the theoretical effects on future wealth. An all-dividends strategy generates zero RRSP contribution room, representing a direct trade-off that highlights the inherent limitations of focusing solely on current year liquidity.
Based on the standard calculations, the document details 3 fully described recommended combinations. The first option focuses on maximizing current year personal cash flow predominantly through dividend distributions. The second option balances immediate and future needs by establishing an $85,000 to $100,000 base salary. The third option prioritizes maximizing corporate capital by retaining funds within the corporation strictly subject to regulatory passive investment restrictions.
Prior to executing salary or dividend distributions, a strict priority list for corporate payments and reimbursements must be managed. The execution principles explicitly cover the deduction of operational website costs and the compliant allocation of home office expenses. Furthermore, it details the 2026 automobile mileage regulations mandating the maintenance of a precise daily mileage log to substantiate any motor vehicle claims.
The execution process for a salary model details the specific tax advantages, associated payroll costs, and chronological steps. Critically, the document issues a strict warning regarding the 180-day payment rule under Section 78, subsection 4 of the Income Tax Act. Any accrued corporate bonuses must be physically paid to the individual within 180 days of the corporate year-end to maintain the expense deduction. For the dividend execution process, the source emphasizes the absolute necessity of confirming the exact classification of available dividends through official corporate tax accounts. The execution requires specific legal steps, including formal board resolutions and the preparation of proper tax slips. The document notes the critical requirement for the shareholder to independently prepare for personal tax liabilities, as tax is not withheld at the corporate source.
The planning framework reviews the basic logic, strict boundaries, and execution steps for private health services plans and health spending accounts. To secure the corporate tax deduction and maintain the non-taxable benefit status for the individual, the plans must be meticulously structured and administered as genuine employee benefits rather than discretionary shareholder withdrawal mechanisms.
Addressing indirect taxation for a digital website business, the document narrates the GST and HST registration thresholds and the application of the 13% Ontario harmonized rate. It emphasizes the strict place of supply rules required for foreign customers to legitimately qualify as zero-rated sales. Ensuring full compliance necessitates the implementation of a consistent monthly reconciliation ledger.
A text comparison evaluates the differing impacts on registered accounts and pension entitlements. It details the utilization of the $33,810 limit for RRSPs, the $7,000 limit for TFSAs, and Canada Pension Plan contribution requirements. The core analytical distinction highlights that recognized salary income fundamentally generates RRSP contribution room and CPP pension entitlements, whereas dividend distributions do not.
The document defines specific risks associated with accumulating corporate retained earnings. It notes that generating corporate passive investment income exceeding $50,000 systematically erodes access to the preferential small business limit. To mitigate this risk, the text explains the conditions, corporate advantages, and inherent trade-offs of establishing an individual pension plan, particularly noted for individuals exceeding 40 years of age.
The analysis establishes strict criteria defining reasonable family salary allocations. It subsequently defines the tax on split income, or TOSI framework.
The documentation explains the severe risk of triggering a 33% tax rate on dividend distributions directed to family members, unless explicit exceptions such as the excluded business rule based on minimum operational involvement are conclusively met.
The memorandum directly outlines 12 absolute prohibitions to ensure legal integrity. The text reinforces that utilizing corporate funds to pay personal mortgages, artificially disguising personal consumption as a business expense, and failing to maintain proper contemporaneous documentation are not lawful tax planning strategies and represent severe compliance violations.
The execution logic is structured across a chronological timeline delineating actions at 30, 60, and 90-day intervals. The plan transitions from establishing separate corporate bank accounts in the first 30 days to fully implementing the modeled plans by day 90. This deployment is sustained by the integration of strict monthly and quarterly administrative compliance checklists.
A specific set of required materials must be compiled for the comprehensive CPA review package. The document reiterates the final order of execution based on the 3 primary operational objectives. Furthermore, it enumerates the critical financial triggers, such as material profit variance or shifts in passive income, that mandate an immediate remodeling of the entire execution plan.
Concluding the analysis, the appendices address secondary structural risks. Appendix A details the specific trigger conditions that mathematically justify establishing a holding corporation. Appendix B analyzes the severe tax consequences associated with a personal services business classification. It narrates the strict 4-factor test used to determine if an independent corporate contractor carries the risk profile of an incorporated employee.